Hello everyone, I'm Nate Crosby from Crosby Advisory. Yesterday on Facebook we made the bold statement that it was possible to obtain $1 million worth of life insurance at no long-term cost. And today I'm going to show you just how to do that. Before we get started, we're going to go over some basic terminology. There are many different life insurance policies out there, but when we break it down to its basics, essentially there are two kinds. There is temporary insurance, also known as term insurance, where we select the amount of time that we want covered for. And then there is permanent insurance. Permanent insurance covers us until death, or at least until maybe we cancel it prior to that, but as long as we pay the premiums, it will cover us until death. First thing we're going to do is analyze the cash flow on a 30-year level term for a 40-year-old male who qualifies for the preferred class at $1 million worth of coverage. So as long as the premiums are paid, $125 per month, which kind of is in the middle of the row as far as companies for that type of level of coverage for that long. As long as he pays the $125 per month, he will always have $1 million of coverage for the next 30 years. So let's take a look at the cost of that. We've got $125 per month times 12 months equals $1,500 per year. And then we of course multiply that times 30 years. So if this individual held that policy for the entire 30 years, they would transfer roughly $45,000 to the insurance company at the end of the 30-year term. They're without insurance and no way to really capture or recapture that $45,000 that they spent. Now, a 30-year term life insurance policy is commonly selected by younger parents because it offers the stability of knowing that coverage will always be in place for 30 years. However, as you can see, at $45,000, in this case for our 40-year-old male, it's also the highest transfer cost to them that they are not able to recapture. So let's look at that a little bit differently. What if this 40-year-old male still needs $1 million worth of coverage, but he's got children that range between 5 and 10 years old, and we determined that the most critical age for critical time for life insurance coverage is the next 20 years. So one of the things we might do is to get that $1 million worth of coverage is we write him a $900,000 20-year term, but we also include a $100,000 permanent policy. In this case, it's an indexed universal life policy to give him the total of the $1 million of coverage. The cost of that is $128 per month. 55 of that is the term policy, 73 of that is the permanent policy. And let's see how this policy stacks up to what the 30-year term does as far as cost. As we said before, the term portion of this combination is $55 per month. So we take $55 per month, 12 months a year, gives us an annual premium of $660. Now, if we carried that through the life of the term, the 20-year term, we would transfer away $13,200 to the life insurance company, and this portion of it we are not able to recapture. However, remember, we paired this with a $100,000 permanent policy, which does build cash value. And an indexed universal life policy has the ability to gain interest credited by market performance. We've got no market loss potential, but we do have the potential for market gain, at least market accredited gain. The average annual credit for the indexed UL policy over the past 30 years has been 8.6%. Now, for this illustration, we're going to reduce that because I don't want to use the average of what is done. I want to assume that we're going to do less in the future. So for this instance, we illustrated an interest rate of 7%. So we're reducing it almost by a 1.5% here. If we look at that, after 20 years, the cash value in this permanent policy would be projected to be $19,930. So consider this. After 20 years of having $1 million insurance in place, if our 40-year-old male decides that they no longer wish to have the insurance, they could cancel both policies and take the cash within that permanent policy, which is $19,930. Now, they gave the life insurance company $13,200 from the term policy, right, over that 20-year period. So essentially, you can look at it this way. They're up over $6,000, almost $7,000 in cash value during that 20-year period of time. So we could look at it as we walk away with almost $7,000 in cash value, and during that 20-year period, the life insurance company provided us $1 million worth of protection. Now, how does that compare? Plus $6,730 to transferring away $45,000 to the life insurance company. And the benefit of this is after the 20 years, we still have that permanent policy in effect if we want to keep it. That's our decision. Now, before I leave you, I just want to point out, am I saying that there's no reason to ever purchase a 30-year term? No, that's not the case. In many instances, you may find that we actually do need coverage for 30 years. And in that case, it may be the most cost-effective to do a 30-year term. But one thing to consider is, with some careful planning, it is possible to have our insurance coverage during the period of time which we need it, and also recapture the cost of that later in life as well. I'm Nate Crosby. Thank you for watching.